Ken Shinoda joining us right now. He's portfolio manager over at DoubleLine Capital. And Ken, we haven't spoken since the election. You've seen the rally in the equity space, and of course, you've seen a lot of the volatility in the bond market space as well. Do you have any sort of sense here as to where yields may go next, and whether that is indeed going to be driven by policy coming out of Washington?
Absolutely. The rise in yields started when the probability of a Trump win started increasing after the September FOMC meeting. And we saw a big sell-off on election night and in that morning. But the market's kind of settled down here. I think it's kind of a little bit of a buy the rumor, sell the news. The research analysts all talk about this big fiscal stimulus that could be coming, more deficit spending. But in reality, we have to kind of wait and see what they're actually going to roll out. It could be some cutting of spending, too. And I think that's maybe why the bond market has settled down. We reached critical kind of 450 area on the 10-year, and we had a really good 30-year auction last week. It was the best auction since 2018. So we got some dip buyers that stepped in.
You know, there are a lot of layers, of course, to the Trump trade, a lot of layers to what's going on in the fixed income market. And when you look at the rally that we've seen in small cap stocks, whether you want to take the Russell or the SML or whatever, I'm wondering, Ken, if you think that that could potentially translate into more euphoria around some of these small cap companies and their debt.
Definitely. I mean, what the bond market is pricing in is good times to come, because spreads on investment-grade corporate bonds are at a post-crisis, when I say post-crisis, post-global financial tight with a 7 handle. We broke below 80, and high-yield bond spreads are also at a new post-crisis tight. So the market is saying that they don't believe defaults are going to be that high, and that the economy should be rolling along, and we'll see minimal defaults in those corporate credits.
So does that make corporate credit in the high yield space more attractive than small caps, given the run-up that we've seen already in small caps?
Small caps probably have a little bit more room to run, but if you look at the equity market broadly, we've seen a stellar year. I mean, I think we've made 50 new all-time highs. Yep. But given where valuations are, you know, the forward-looking returns using PE ratios or cyclically adjusted PE ratios call for low single-digit returns broadly for U.S. equities. So where you can buy some of these credit assets up near 7%, that could be competitive for equities.
I want to go back to something you mentioned, which is this idea that there might be some cutting of spending. What is the scope for that, and how much of it does it depend on the economic data that we get? We know the Fed is very data dependent and is going to be in reaction mode more than anything.
Well, I hope we cut spending. We'll have to see if it happens. But, you know, Elon Musk has been a big proponent of Trump, very vocal out there, saying that he's got ideas on how we can solve the deficit. So there's a lot to hope for, but at least I think we have a potential chance. And I think that's what the market is looking for, is guidance on, yes, we know there's going to be tax cuts that's bad for the deficit, but perhaps on the other side, we could see some cutting of spending as well.
When do you think we are going to get a little bit more clarity on how that all balances out? I mean, this is something that I think, at least on the surface, I would think could take a few months, maybe even longer, before we have a real sense here of what that equation looks like.
I don't think we're going to really have a good idea until we're in the first quarter next year, and Trump comes into office, and we see how things play out. So a little bit of time before we get more clarity there.
When it comes to this idea of how other areas of this market could be affected by some of those policies, I want to talk a little bit about what we were seeing in the commercial real estate market, particularly when it comes to some of the asset-backed debt. And I'm wondering if there is a direct feed-through that we can look to as investors from some of those potential policy changes and any relief that we see in that sector.
Well, there's going to be pushes and pulls in the commercial real estate market because they're really debt driven. So to the extent that interest rates have moved higher and stay higher, that's a headwind. Now, at the same time, the debt markets have opened up. While the banks aren't really lending aggressively, the CMBS market is wide open. So buyers of real estate have the ability to get debt and invest in assets. And we're seeing renewed interest both on the equity and debt side of buying assets, investing in assets, lending. So that is a tailwind, is the availability of debt. And if corporate profits increase because of tax cuts, then maybe they'll be expanding their businesses. Maybe they'll be taking out new office space, renewing that lease, and you'll just see general activity for those commercial properties increase, and that's a good thing for them.
Right. Now, there are a lot of hypotheticals that we're speaking in here, Ken. This could happen. We're looking for this to happen, and for good reason, because we do know that President-elect Trump has made good on many of his campaign promises. But with no specific details on fiscal policy, trade policy until probably the first quarter of next year, as you said, what is the rally that we're seeing in small caps, in banks? What is it going to be premised on? Are we going to rally on fumes going forward after this, initial first 2 weeks of euphoria?
I mean, that's just it. We're kind of rallying on the hope of better things to come. So I think a lot of that is priced in.
Yeah.
And I think maybe equity markets probably calm down here, and fixed income markets, I'm sure, calm down. And I think those things are kind of happening in tandem.
All right, Ken, always a great conversation. Ken Shinoda, portfolio manager at DoubleLine Capital.